All right, YouTube, welcome to another segment of Freyman CPA. Today we're discussing tax planning, part 2, deductions and related strategies. All right, I'm gonna make some room here because this is everyone's favorite topic. And last we spoke about income and how you can tax plan using income strategies. This segment is more related for business owners than it is for individuals. And that's because for individuals, when it comes to deductions, there aren't many. There's overlaps for sure. So when I'm going to talk about medical deductions and things like this here, this will most likely also relate over to somebody that's in a W-2 type of employment situation where you have a traditional employer and you're the employee, and but the benefits are typically coming from the employer. So in this segment, again, we're discussing the business side of things. In this segment, we're discussing where you're the employer, you're the one in business employing others, and we're discussing specifically either a sole proprietorship, an LLC, S corporation. I'm not discussing C corporations. They're a different ballgame altogether. So let's dive in. Let's take a look at some basic tax strategies. And they're a little bit of a smorgasbord, if you will, of different things that I thought would be pretty common, and some not so common, out of the box type of stuff that you probably never heard of and would love to learn about. I'm actually leaving those for last because I want you to stay tuned. All right, but first let's cover the more common known deductions. Now again, remember when we're speaking of deductions, you're spending money. And in our tax office, we have the saying, don't let the tax tail wag the dog. One of my clients many years ago mentioned that to me when we were discussing tax planning, and kind of stuck around, and we love that expression here in the office. And we typically mention that to our clients because we first always remember, what do? We always do things first for financial reasons, or we do them for maybe moral justification, but we do not do things here primarily for tax advantages, because it's like spending $1 to save 20 cents. At the end of the day, you have to spend the money. So we want to first see, does spending money, which is AKA deductions, really make sense first and foremost for my finances? Can I afford it? Is it going to save me money in the long run somehow? Or is this just a good moral thing to do? For example, I'm charitably inclined. So that would be a great reason for me to donate to charity because it fits my religious beliefs perhaps. And that comes first before actually worrying about the tax benefits. Now, when we're dealing with medical costs, we do have, so when we're dealing with tax strategies and deductions, all right, one that is very often overlooked and often discussed is medical. All right, when we're dealing with medical, some very common setup would be an HSA, so a health savings account, or a long-term care, or a health reimbursement arrangement, health insurance, and that can primarily be, different types. That could be vision, dental, obviously traditional medical coverage, and then there's other types, disability and things like that. There's different forms of insurance, but here, specifically I'm discussing medical. So HSA, everybody knows this one. If you have a high deductible health plan, which is your health insurance, and you're young and you're basically don't get sick very often, then you probably have a high deductible health plan, so your out-of-pocket costs are pretty large, and but you need to be insured, so you still have this insurance. It's probably pretty costly, and you'd like to not have to spend that out-of-pocket when you do go for different doctor visits, but you do so, and when you do so, you can do that from a HSA. An HSA works like an IRA. It's a health savings account. You're basically placing money into this account. You get a debit card and you go and you use it for out-of-pocket expenses, or you request reimbursement from the HSA fund whenever you need it. So in other words, if for some reason you need to go see your doctor, you have co-pays, you're going to use that card and you're basically putting it through pre-tax. So when you're making this contribution to the HSA, it's actually a deduction. All right, now for S corporations, it has a special treatment. It's actually treated as, basically it's deemed compensation. So this would actually be a payroll item and it's treated a little bit differently. I'm not going to dive into how exactly it's treated, but all you need to know is this is a tax preference item. Being self-employed in general, whether you're, and when I coined the term self-employed, I'm not coining it for, self-employment as in the general sense, not in the tax sense. Because when we speak about in the world of taxation, self-employment means one thing, S corporations are completely different. It's not self-employment for tax purposes, but in everyday language, self-employment is just people that are in business. All right, so when people are in business for themselves, we get a lot more perks of doing business. So the government gives us all these different perks to basically use it as much as we can, stimulate the economy and so on and so forth. But so we get to deduct things where others might not necessarily get to use it as the same way we do if you're just a regular employee. So that's anyway, so the HSA, whether you're an LLC or you're an S Corp or a sole proprietor, this is definitely something you should look into. It's a great way to get those costs covered and have nothing out of pocket and get the write-off, basically. Long-term care is also deemed compensation as well as health insurance. So these are really like 1, 2, and number 4 are all deemed compensation. Either for an LLC, which would be guaranteed payments, or W-2 income, for if you're an LLC or you're an S Corp. All right, so they're treated differently. They're treated as separately stated items, and they have to be treated a special way. But again, the premise is the same. You're basically getting to write them off. All right, so you have to pay this anyway. You might as well put it through your business. There's different ways of putting it through your business, but the most direct way is obviously just pay it out of your business account. All right, the HRA is a little bit different, and it's quite unique because the treatment is very different whether you're an LLC or an S Corp. All right, so let's talk about the HRA real quick. So if you have a health reimbursement account, your employee has to set this up with a special, I forget the name, but it's a certain type of company that does this. They set up a plan. Your employee basically submits expenses to this HRA plan, and then the HRA basically reimburses the employee directly. So they're like an intermediary. All right, but the HRA, the health reimbursement arrangement, if you're an LLC, is one great way to put through expenses versus an S Corp. Or for C Corp, it's completely differently. But again, we're not talking about a C Corp. For an S Corp, it basically, it would just go directly as a reimbursement. For LLCs, there's an actual tax strategy that can be done that is not allowed for S corporations, and this is under section 105 of the code. Okay, so under section 105, if you have an LLC that's made up of a husband and a wife, and the wife is doing work, so she's a worker, and the husband owns the business, and this could be a sole proprietorship, owns the business, right? Under this LLC, and again, this could be a sole proprietorship. And the way you can do this is, let's say the wife has medical bills. What you can do under a section 105 plan, this is section 105 plan, is the wife would perform services for business and submit a reimbursement of the medical costs reimburse. And basically the LLC would then, if she submits these expenses, right, to the LLC, then the LLC can reimburse the wife the money, and it would be considered compensation. The benefit of it is that there's no W-2. So it becomes a reimbursement, and you're saving in taxes because you know, this is basically a way of being able to channel money from the business over to the owner, get a full deduction, but no income to the wife, no W-2, and basically just picks it up as a reimbursement. This is only available to LLCs. It's not available to S corporations under the current law. So that's the Section 105 plan. And so again, it's available by hiring covering the spouse with family coverage, and that's applicable to the proprietorship and single members. I'm not going to talk about C corporations, but for S corporations, it's not available to more than 2% owners or their spouses. Again, if you have employees, things change. I'm assuming just husband and wife working. There are discrimination rules in our world, and much like the next topic, if you're paying your medical insurance, and this is all basically assuming either one member or shareholder or you know, type of situation or spouse. I am not discussing when you have employees, because once you have employees, then you're discriminating and tax rules change, and sometimes you're not even allowed to do the following that I'm about to discuss, which is retirement plans. So next up is very common, and this is as common as dirt. And this is also, again, subject to discrimination rules. So if I'm the only owner, I can, of course, open up a SEP IRA under the business, or a simple IRA or a simple account, and not have to worry about discrimination. But once I have employees, I have to offer that to others. And the same goes with medical. Medical, I don't really have to offer it, but then I lose favorable tax treatment if I don't offer it to others that work for my business. So with retirement, I mean, this is also, just like I said, is as common as dirt. Everybody knows what this is. I'm not going to spend a lot of time on it. It's a very straightforward concept. You put money towards retirement, and you don't really technically can touch it until a certain age. That age is 59 and a half, and you can't pull that money out in certain circumstances, hardships, rollovers, you know, that sort of thing. Maybe first time home buyer, but once that money is in there, if you pull it out, you're going to trigger taxation. If you put it in pre-tax, and you're also going to trigger penalties, because it's not a bank account, it's a retirement account. So that's how retirement accounts work in general. There's as many as you like. There's the SEP, there's the 401k, the solo 401k, which is more common, simple. All right, and when people come to us, they usually ask, like, well, what's the better one to really use? And you know, we'll give them guidance and basically explain to them how they work. We don't actually open them for people. We don't have any invested interest in you know, what they do. We just basically explain that, you know, you have pre-tax, you have post-tax. Obviously, if you're doing something pre-tax, and when you pull the money out, it's going to be taxable. And it's saving you money in taxes now versus later. So that's where the real planning really comes in, is because you want to think about if you're saving the money now versus later, you might not get as much deduction. So let's say they change the tax rates next year. If I wait to make my contribution for next year instead of using all that money in this year, I might save more just on the difference in the rates. So that's the basic premise. But other than that, people typically will want to max it out as much as they can, and something like the solo 401k will obviously allow you to max out much more between the simple and the SEP because of the mechanics. A SEP is just a certain amount, but the 401k has, solo 401k has two components. It has the employee component and it has the employer component. Whereas this just has the profit sharing component, and this just has also, I believe it's a profit sharing component, but it's the limitations are lower. I believe it has both components as well, the EE and the ER, but you know, it's a lower threshold. So where the bar is here, over here the bar is higher. Okay, so that's basically retirement plans in a nutshell. I don't really think that there is much else to discuss with retirement plans. There's a million strategies that we can discuss about retirement plans as well, but that's not the premise here. The premise is to discuss more like what saves us money in tax, what's your basic stuff that everybody's heard about, and just giving you some more information than what you typically hear. Now, so again, these are all kind of like fringe benefits. All right, so here's one for keeping up with me, fringe benefits for transportation. So the way this works is you come to here, here's the employer, and here's the employee. And basically, what you're doing is you usually pay the employee a net pay of, let's say, $400. And what you're doing is you're basically going to have an arrangement between the employer and the employee where you're going to withhold from the pay, let's say $30, and the employee is now going to receive $370. But what we're doing is we're withholding this money and we're using it for transportation. So the employer is buying the transportation and giving a transportation card or some sort of other arrangement to the employee, and the employee just gets less money. But the key component here is that the money is coming out of the gross pay, not the net. So it's not subject to taxation. So for the employee to be able to buy $30 worth of transportation, how much does the employee need to earn? The employee first needs to earn $40, then the employee is going to lose $10 to tax, and then the employee can go and spend the $30 to buy the transportation pass. So it's basically not really the best setup. So instead, what you do is the employer will withhold the $30 pre-tax, right? And go and buy the transit pass or whatever for the employee. And this way, the employee actually saves money in tax, and the employer doesn't have to increase the wage, but it's like as if the employee got an increase in his compensation, because the employee no longer has to actually have this whole process happen. So the employee is winning money and the employer is winning money as well. So it works for both sides. In the city of New York, it's actually a requirement. It was when we were living there. I'm not sure if it still is. I would imagine things have not changed. But it basically was, if you had over a certain amount of employees, you basically had to provide transit passes. And so that's the fringe benefit for transportation. So it's a very common setup. And it would typically work something like, you know, there's a small formal arrangement, the employee signs off on it. I had this when I was working, and it was saving me some money because I was actually increasing my pay with that, and the employer was getting, you know, basically looking better in our eyes, or at least we thought so. Anyway, so that's a little known trick right there. And by the way, it doesn't have to be just the transit pass. It can be a parking arrangement for like a bicycle or just a regular parking spot, what have you. I think there's some options there. It doesn't have to necessarily be like a train ride. Anyway, so now let's talk about, since we're talking about fringe and that sort of thing, let's continue on with that theme. So reimbursements. Reimbursements are really, and we spoke about that many times, but when we're dealing with employees, you have your auto, you have your home, you have other, that could be like cell phone, even like health related, as we said, HRA. And we spoke about the Section 105 plan. So in general, when you're dealing with reimbursements, it works for both sides because, again, the employer gets to retain talent. He gets to, or she gets to help out their employees. And sometimes, like I said, it's just, in our case here, it's just you, right? Or maybe a spouse and you. So reimbursing yourself for the auto is a great way to go because you're spending that anyway. But when you're dealing with, everybody else, it's also a great perk to have. So people will love it. They'll want to retain their jobs. But the idea is the same. Your business is spending the money. The employee is in receipt of that money. And it's not taxable if under an accountable plan, right? And the employee gets the deduction. The business gets the deduction. So it works for both people, both sides of the table, rather, both entities, right? Okay, so that's reimbursements. And when it comes to business, buying, purchasing, so when dealing with purchasing and depreciation, without diving into too much specifics, because we touched upon this in the income section, right? When you're dealing with purchasing, some tax planning would be basically like credit cards, and of course financing assets. So you're basically, you haven't paid for it yet, but you're getting the deduction now, and you can accelerate the depreciation. So depreciation can be done either at a prescribed method or accelerated methods. And again, here this is a discussion that we would have in a depreciation segment. We're just dealing with more taxes now versus less taxes later, and or the vice versa. So it really, it's kind of interrelated. When I'm buying things, if they're a certain amount, then we're looking at something that we're going to depreciate, and then we have to decide how we're depreciating, how much tax deduction that's going to create. But at the same time, the concept is I haven't spent a penny yet, but I'm already deducting things, and then I get to choose how I'm deducting, accelerated or standard. Standard could be 5 years, 7 years, something like that, and that's a very separate deduction. We kind of touched upon that in the auto section. So yep, so that's depreciation. Again, these are just common tax strategies. Again, things like notes and IOUs do not count. So you can't say, oh, I owe you and get to write it off. You have to be on the hook for it. You have to be legally on the hook, and that's credit card or financing. Entity selection, yes, entity is another one. If you're going with a sole prop, LLC, S Corp, or C Corp, you're in for quite the difference in taxation between, these are taxed pretty much the same. This is its own animal, and this is even worse of an animal. Here you have double taxation. You almost never want to do S corporation. Most people end up either here or they end up here. All right. So yeah, this one has just like a whole host of things. And even when we were doing comparisons when the tax reform came out, it's still almost never a good idea to go with a C Corp. because because of the double taxation. Because of the double taxation, because when a C Corp is paying money out as dividends, that's the only way you can get money out of it besides your W-2 salary. These dividends would still be subject to tax to the shareholder, and the C Corp is paying its own tax at corporate rates. Right? So that was just, it's not favorable. So you're paying long-term capital gains here, you're paying corporate rates, which is now flat 21%, right? And maybe another 0 to 20%, and then you have the net investment income tax on top of that. So it ends up more than the S Corp or sole prop or LLC type of scenario. So yes, entity selection is very important, and that is definitely a big part of tax planning. But most of the time, like I said, it just comes between those two. It just really comes down to the LLC, sole prop, or the S Corp. For most small businesses, you hardly see C Corporation unless for a specific business reason, and most people don't actually set up C Corporations for that specific reason, although they'll come around and ask for maybe the advice between LLCs and S Corps. S Corps have a lot of benefits for sure. I'm saving the last one also as well. I'm going to discuss one more before I go, but yes, so once you're dealing with choosing an entity, you have to always remember that there's so many moving parts, and when we're discussing that scenario, it's usually not always the best thing for people to kind of get fixated on a particular projection. So if you're ever out there and you're shopping for an accounting firm and they try to sell you on one way versus the other, I would shy away from that accounting firm, because that's typically like a snapshot in time. When somebody gives you a projection, says yes, and don't get me wrong, sometimes it definitely will save you money to go one way or the other, but just be wary, because that is a snapshot. So they say, look, I put down the numbers like this, and I put down the numbers like that. This is your profits as an LLC, and this is your profits, and this is how much taxes you'll pay as an LLC, and this is how much tax as an S Corp. Yes, but that's only under that specific scenario, only on that specific situation, and in real life, that's going to change. Things are never going to work out the way they did on that piece of paper. So don't get fixated on anybody's plan. And there's a lot of people out, yes, you should still run the numbers, you should still understand, but just know that things change. And they can change so greatly that everything that you planned and looked at goes out the window. So keep that in mind. Now, last but not least, I just want to talk about shifting income. And that typically deals with employing family members or children under 18. If you're, one great strategy, if you're an LLC, okay, and this does not apply to S Corps. All right, so if you're an S Corp and you have like a minor that's below the age of 18 in here, and you're basically, and this could be a sole prop, and you want to pay them, so you're shifting income, you're going to pay them money, right? Here, you won't have to do any employment taxes for the work that they're doing. Now, you can't just shift over money to a minor under the age of 18 just for the heck of it. They actually have to do work. There should be a timesheet. You should actually be performing services, and that should be documented. It's not just, let's just shift some money to the kid. That's illegal. So, but with S corporations, so no employment taxes in here, yes. Employment. So when my kids actually worked for me and my business, and they were under the age of 18, they were actually getting a W-2. And yes, they still paid less in taxes than we did, but they had to pay employment taxes, so they got a little bit of Social Security and Medicare going. And it was reported on their W-2. Here you still get the W-2, but there would be no, I might be wrong on this one. I don't really run into the situation. They might not need a W-2, but definitely no employment taxes. All right, that's one way. Another way to shift income would be to, and this works for both the LLC and the S Corp, and this is a great strategy. You basically offer shares. So, you know, you have business owner, and here you have business owner. And let's say you used to owe 100% here, and you used to own 100% of the profits there. But instead, you're going to say, well, I have a parent. I'm going to have him do some work, or not, and basically give him 10% of the profit. And now I'm, let's say, in the 37% federal tax bracket, but my parent's retired, he's elderly or she's elderly, and she only pays 12%. So as a family unit, we just save money. I still get some work done or don't get work done, and I can shift income. And as a family unit, we're saving money instead of paying 100% times 37. Same holds up here. You give interest to a parent. All right. So that's another way to legally reduce taxes. Similarly, here's another one, which is also rarely spoken of, is when we would do basically selling or gifting and leaseback. So selling or gifting and leaseback assets. So here's my business. All right. I gift it over to my parent. Then the parent rents it back to me. Okay, so I'm writing this off at 37%. My parent is picking that up at 12%. So I saved 37% and he's paying 12% taxes. So that's where the difference of 25% savings comes from. That right, math? That's right, math. Yep. Still paying attention. Nice. So 25% savings. And can lease it back to me. Does that make sense? Wait a minute. So yeah, so I gift it over, right? And then yep. So then they basically they lease it back to me, and I'm paying now money to them. You know, after. So it really should have been like this: gift. All right, and then the parent rents it to me. Right, and I'm paying them back. So I'm writing off 37 and the parent's picking up the income at 12. So that's selling, gifting, lease back. All right, folks, well, that concludes yet another episode of Freyman CPA Tax Planning. This is the second episode and the last one. I will not delve into more tax planning insights for this particular segment. If we do any more tax planning, we'll try to just do them separately. Tax planning is a vastly large topic. There's just a lot. There's tons to tax planning, and we can just go on and you know, in so many directions. That's why when folks come to us and they say, well, my taxes are real simple, I always beg to differ, because taxes are very not simple. There's just so many situations out there and so many strategies and so many so much evolution of all these strategies that as soon as they come up with a new law, there's people scrambling to figure out ways around it. And that's why we're employed, and that's why, you know, that's our job, is to figure out all these little nuances, nooks and crannies, and basically make sense of it, bring it to you, and make sure that you're getting the most out of the tax system. Remember why we do that. It's because your success is our success here all day at Freyman CPA. Thank you.